Guys, it is Saturday, April 16th, and this is Markets with May, and we're going to talk about my initial reaction to the bank earnings season that just came to pass on Friday. So we have a bunch of companies that reported. We still have the bulk of the financials still to report, but we got some really big hitters that came out on Friday. BlackRock, Wells Fargo, JPM, Morgan, Citi, and PNC. So one asset manager, very important, three of the mega banks, and then PNC, one of the larger regional banks. And so I think it's kind of interesting because I would definitely say unambiguously better than I expected. For sure. Do I have positions in these? Yes, I do, across pretty much all the financials, past performance, not indicative of future returns. So we can jump right into it. All right. But I would say that the four major questions on how I'm organizing this is number one, how are money flows going in general? Number two, how did the banks do? Number three, are they healthy? And then the metrics that are associated with that. And then we're going to talk individual company reportings, the strategy I'm seeing, and a few comments therein. Yeah. So I will mention, though, before I get into that, tomorrow, if you are following Microsoft Activision, I'm going to be posting the times for that, but I am going to have Florian on with me, as well as, hopefully, knock on wood, everything gets timed out right. This friend of mine who's an amazing options specialist, who even when I get confused or what have you, I usually will see what he's up to. And so we'll be talking about the Microsoft Activision deal tomorrow. If that's exciting to you, definitely subscribe to my channel, because Florian's one of the best people that I know. His Twitter is one of the best as far as following how to think about the timing of the transaction happening. Okay, so now let's get into banks. Let's get into financials. That's my shameless plug to join me tomorrow. It'll probably be around 11 o'clock-ish, but you guys just follow me on this and or Twitter, and you will get to see it exactly as is. All right. I start with BlackRock. And the reason I'm starting with BlackRock and the asset inflows, which they achieved, asset inflows despite a kind of speckled, let's call it, earnings report, is because when it comes right down to it, if we're going to see some of the things happen that will need to happen, I have mentioned for some time this is a 2-quarter scenario that you have to watch if you want to understand the financials and the banking system. And it really comes down to these guys, the pension fund and sovereign wealth assets, and where they're going to come in and try to help with a lot of this held to maturity that's still going to have to resolve itself, even though while saying that, I don't necessarily think held to maturity is the right place to be looking. And we will go through that further as we go through. Nonetheless, BlackRock is the first data point that you get on what did they already decide to do. But as a beautifully smart woman reminded me the other day, these allocations, except to liquid, are done 6 months, 12 months, sometimes in the making. And so I do want to kind of demonstrate two parts of this. Number one, the earnings was not great for BlackRock this quarter, but we care about, because the nature of what's going on, is the inflows. And they did have net inflows of 110 million, which is pretty great. That basically that implies to me that nothing slowed down, even with whatever was happening on earnings. Now, whatever was happening in the banking system. Big deal, because it does have implications across a number of areas of finance that we have been talking about this entire time. Now, I do want to show the net fund flows, which come off of BlackRock. And you can kind of see here that the key thing is that money's coming out of equities. And we have talked about this for some time. In the last few episodes, I have talked about the fact that the allocation to illiquid assets, whether they just be classic illiquid assets, real estate, parts of fixed income, et cetera, or whether they flat out are liquid alternatives, which is kind of its own thing, that is totally been the trend for some time. And that trend has been a decade, okay, and coming. This was from equitable.org. It demonstrates the statewide pension funds, and the increase of the yellow and green bar is the increase into illiquid assets. And we had mentioned and talked about in many episodes, I can link them in the show notes as well, that trend's going to continue for many reasons, not the least of which is it's a better match of liabilities to assets. And number two, they don't have to take the marks. They just have to make sure that they stay liquid enough to fulfill whatever is their requirement. In the case of pensions, paying the pensioners. In the case of private wealth, sovereign wealth, it's whatever works that they allocated to. And that can always be adjusted in a way that's very different from what other liability mismatches are within the marketplace. Okay. So the net flows already and continuously show that flow away from liquid assets, namely equities, into fixed income, definitely happening because we keep increasing interest rates, and also the private markets. Very clearly, you can see it here, but we'll need another quarter because some of the decision making and conversations would have just happened at the end of the year over concern, not even in advance of Silicon Valley Bank. So we'll see more this next coming quarter because there are some larger pension funds that would have had the timing right on top of some kind of allocation meeting, and then they would twist a little bit faster. And then others might take up to a year to do that kind of transition. But my suspicion is, given the current nature, it's probably closer to between 3 to 6 months. You'll see some twisting of allocations, and we can kind of see some of it here, but the bulk of it will come through next quarter. Now, that does mean that this quarter, even though the private equity folks are not necessarily a part of the S&P 500, I'll probably be monitoring them just as closely as I do the other companies that are part of the S&P 500 to just kind of pay attention to what's happening broadly in asset flows. But here's your first data point. Okay, so now I'm going to go on to the banks because I don't want this to be forever. There's a lot to unpack with each of these, but I like to just answer the question, how'd the banks do? And the answer is the banks did great, okay? Better than I expected for sure. And I split it into two parts because I really want this to be understood. I want it to be understood very clearly that there's how did they do as relates to earnings, and then there's how did they do. Hold on, let me stop sharing for a second. Splitting it into how did they do relative to revenue, earnings, things like that, and how you would do valuation is one thing. But the second thing that you have to do in this particular market environment is how are they doing as relates to any portfolio deterioration. So that's usually I would have already had this video out a lot earlier, but because I went back and double checked and did a lot of that extra work to give you guys more summarized metrics that would simplify the one-liners for you, that's what took so long and why we're doing this on Saturday instead of Friday. Thank goodness for the weekend. Now, let me go back to sharing my screen here for a second. Here is the summary that I made to try to help everyone out on the quick. If you look at earnings, they were freaking amazing, for lack of a better way to describe it. JP Morgan, revenue, top line growth of revenue 22%, EPS 52%, and on down. Wells Fargo up 16%, on revenue up 31%. So on and so forth. Why did this happen? Okay, this happened for a simple reason, and that is they were the net beneficiaries, JP Morgan, of all those assets coming in, and then that huge net interest income that's associated with it, plus any fee revenue they got from taking asset management portions from other folks. Okay, that's really unambiguously what happened. Then when we then use other valuation metrics, return on tangible common equity, that's going to show extremely good. How good? Because I know a lot of you never follow these guys, so the magnitude is still something you're getting used to. Wells Fargo's never had, I mean, like it just in the last few years that they've been working through their mess, they've been nowhere near 14%. So them getting 14% has a lot to do with how deposits switched and how this switched and that switched. That's what that 14% is all about. I know there's going to be some people that feel differently. Good for you. I don't agree. Okay. Citibank, same thing. PNC, same thing. So it's not only the higher interest rates that we've experienced, but it's also the wider spread that you're allowed to take when the market gets really volatile like this and crazy like this. Okay. So they are benefiting like crazy as relates to just making money for retained earnings. That sort of thing, making money to try to recapitalize the banks, as some people call it. All those jargon words that you're hearing are showing up. Book value, if you look at that, this is how it lays out. This means that none of them are particularly cheap or expensive unless you want to consider Citi very cheap. Citi trades at a discount for a reason, but darn are they being helped out right this minute by the dynamic, because they are in many ways a bit of a winner. They're Their return on tangible common equity, by the way, was 5% before this all happened. I mean, take a look at it. So this is a double, is what we're seeing here. But it's so this really has helped out the banks as relates to just money making power. Okay. That said, let's take a look at credit quality, and that's going to be the thing that's discounting these banks. But and I'll tell you how it then sets up. It means that if these banks, or if we can get through this period, the whipsaw on the banks, if you think it's been ferocious in this last couple of weeks, is going to be even more intense. So when we look at charge-offs, those charge-offs are high. And guess what? Because all that people cared about was deposit beta and all these other things. I didn't hear nearly as many analysts asking about the charge-offs, and they should be. Okay? Because here's the thing. The charge-offs are low relative to historic levels. 2% is the highest I saw at Wells Fargo, by the way, and even though, okay, so you got charge-offs, you've got vintages that you can look at, meaning that things that were not paid in 30 days have now moved to 60 days and 90 days, what have you. And you've got a bigger allowance for credit losses. What's that mean? Well, last year around this time, because the economy was doing amazing sauce and we hadn't inflated our way through a year of craziness, you saw actually banks releasing capital for credit allowances. Well, they're doing the reverse of that. Specifically, Wells Fargo and Citi at this time last year were releasing capital because they just reserved so much going into COVID, and now they're taking it back in. So that trend is released. That's the one place where you can see a little bit of reduction in liquidity, which everybody was focused on and asking about. For whatever reason, people don't care as much about charge-offs because it's still well under the stated number for what you'd expect given a certain quality of book, given a certain FICO score. But I care. And the reason I care is because the magnitude of the change in the short period of time that it's happened does make you at least raise a little baby eyebrow as to whether or not the modeling of that was done in a way where you won't see what we call correlated default. Okay. Right now, I'm not worried about it for any of these banks. These four that reported, so far, so good. These numbers are fine. But we're going to look for it in the weaker parts of the banking system, namely some of the ones that I think will be fun, as you know, is SoFi. But Mr. Noto, who runs SoFi, has done a really excellent job of trying to wind down parts of that book to reduce his exposure to any of that. You've got Ally Financial. That's run by Mr. That's a Berkshire company in some ways because he's got a slug of it. So probably they're fine, but we're going to have to watch it like a hawk because that's still auto, which has had certain issues, let's call it, on the used market. And then Upstart, which is an originator and shouldn't have any loans on the book. We'll see if they were able to get any off. We'll get to that in just a second as well. Let's talk about CET Capital. Now, JP Morgan, it's interesting because CapD hasn't made it to these earnings reports yet, but I know for a fact when I talk to some of my friends that still work in the business, they're using CapD as their thing, cash as a percentage of debt. Jamie Dimon did speak to the buffer. It's about $433 million, which is higher than his CET capital ratio here stated at 13.8. But what you got to know about JP Morgan is that Jamie Dimon has been bearish for a while. So his little increase isn't going to look as dramatic as other people. Wells Fargo buying back stock. I got no idea why you're doing that. You really should chill out until we get through this mess right here. But he went and bought back stock. No one else is doing that right now. That's the only little criticism I have on Wells. I don't know why they did that, but they did to their credit, when it netted out, increased just a baby hair, that CET capital ratio. It's still not where it was a year ago, by the way, but is what it is. So quarter over quarter increase, but down year over year. Citi increased. They've been increasing all along. Last year, they were closer to 11%. Wells Fargo, by the way, was last year around 11%, but they took a $3 billion charge, which is why it's harder for them to raise it. Yeah, they took a huge charge. Sorry, I'm wrong on the numbers probably. But they took a huge charge in the fourth quarter because of some things that they just continue to have as errors in the way that they do loans, quite frankly. Then you got PNC. PNC picked it up a little bit, but I want to remind you guys that we'll see more next quarter because really Silicon Valley Bank happened in the middle of March, and these guys closed out their quarter at the end of March, plus dealt with all of this other stuff. So it's going to then come down to what are we seeing at the banks and what's the strategy. So let me go through that a little bit for you. JP Morgan, spotless quarter, to be fair, and you would have expected it because he was already so bearish every time you wanted to talk to the man that it's not surprising to me. Tangible equity up to 18% now. I mean, this is the highest, and for a reason. Plus, and for those that don't know the difference between the banking folks and are still trying to learn it, JP Morgan is the biggest US debt place that you'd go to. So they are the unambiguous winner, period. Okay. There's really no other way to say it. Unambiguous winner here. They will benefit from any kind of refi that's happening. They will benefit from, structuring products to try to get them off balance sheet. If that happens, they will benefit. They will benefit. They will benefit. JP Morgan, any kind of concerns pre this should be gone at this point. He's not going anywhere. Okay. But he's also charging more than everybody else. So everybody has a chance to at least compete with him. And that just has to do with the nature of what the business can do at this particular point. They can charge a premium just to make sure that certain things don't overwhelm his system. Should have flipped this the other way around. I just want to show this to you. They were the only ones that showed a minor baby uptick in their auto lending book. And I've told you guys that because of the nature of of used car prices down 11 to 13%. If you were doing the math on it, necessarily you have some impairment on the actual principal value of those loans. If that's confusing, I'll put my playlist in the show notes and you can check it out, what I mean by that. But it just has to do with how you actually go about calculating risk on a bond. And that risk leads directly to what you would then pay for principal, et cetera, et cetera. Okay. This is the part I wanted to show you that's kind of relevant. And it's relevant because we still have Morgan Stanley, Goldman Sachs to come out. Morgan Stanley, Goldman Sachs are more equity houses than they are fixed income houses. So it's a little hard to tell. But this was a decent post, quite frankly, for the investment banking portion of their business. That's banking right here. I mean, it was up quarter over quarter and flat year over year. And I just remind everybody that banking fell out of bed as a business this quarter last year. So whereas it was up against tough comps going into last year and pretty much all last year, the banking business hit the stop sign and hit the brakes on the first quarter. JP Morgan is the first to show you anything that might be going on there. And it's not nearly as bad as I thought it was going to be. So this actually might be okay for Goldman Sachs and Morgan Stanley. I'm probably going to mostly stay out of it. I've double checked. I might have like a Hail Mary call on Goldman from last week or something still remaining, but I was unwinding all of that. Anyway, that's what it looks like here. And then but yeah, better than I expected. Not great because obviously you need the capital markets to fully open up for it to be exciting. Plus, since Goldman and Morgan Stanley do their banking business does notably better, in particular when equities is crushing it. We'll have to see. Goldman's going to report before Morgan Stanley for the first time in a long time. Usually it's Morgan Stanley reports first, I think. But anyway, other things. Yeah, this is the charge-offs up a lot. I'm going to skip that and that. Wells Fargo. Okay. Wells, fair and square, decent quarter. Okay. I just want to show this for folks that are still getting accustomed to the numbers. You can see how much of a change this is in return on average tangible common equity. So it's a big change. And so you got to give them some love for that. But what you don't have to give them love for is the idea and concept of how their book goes. Okay. And I wanted to show this because this is the nature of why I'm not as excited at looking to held to maturity as everybody else is. This is their balance sheet. Okay. And you can see that there's just only 14% of their assets is held to maturity. Everybody's getting really excited about that. But realize that the rest of it is loans, $947 billion. And then what they have in cash and cash against their deposits, 8.5%. Okay, so if you take the deposits and you divide it by the two numbers, the Fed funds sold and securities purchased, that's basically repo money that they're taking in. Okay, so it's a buffer, that 3.5. And so if you do like a cap D kind of concept of it, it's not bad at 12%. But like I said, a bank makes loans off of its deposits. So it's borrowing short and lending long. Okay. So all this stuff that could be loans, provided it's duration matched correctly and they can get it off the sheets, then that's cool. But if they're going to still have stuff going on in there, that'll become held to maturity just as fast. Or alternatively, if we start getting a situation where one of the banks gets attacked, it's not the greatest buffer that they have going on at Wells Fargo. So that would be the only thing that would be like but honestly, if we don't have another attack on a bank in any kind of meaningful way on deposits, then they should be fine, is how I'm going to say it. Yeah. And that's kind of how I'm thinking about it. All right. Moving through this a bit. They also, by the way, have the largest in their loan outstanding book. This was the 154 billion of commercial real estate loans. This was a big theme for most folks. It's really tiny, and for Wells, they tried to play like this is tiny. But when I show you how tiny it is at PNC, you'll see this actually is not that tiny. It's 25% of their CRE book. Now, I have been a little bit irritated that so much of the market is focused on commercial real estate without differentiating what type of commercial real estate. Okay. Because a lot of the folks that have gotten clobbered on having commercial real estate loans actually have very little office exposure and a whole lot of everything else. And it turns out everything else is actually doing great. That was reiterated by every single one of these CEOs. And that just has to do with the fact that, if you're going to close down the housing market by basically making rates so high that it's unaffordable to buy a house, then people move into the rental market. So apartment rates, those REITs, they're doing just fine. And anyone that does that business is doing just fine off of rental income that's increasing, not decreasing. And then most of the other areas of the market are actually doing pretty well. We've got tech layoffs for sure, but we don't necessarily have the same situation happening across every single industry. And so that's what others displayed. But I will say that Wells Fargo does have a little bit more office than others. And does that mean that I think that you should short Wells Fargo? No, I think it's a little bit dangerous to do it because just like everybody else, they're gonna crush it. Okay, I can already see there's some questions coming in on the chat. I will definitely get to those at the end. I got a couple more slides. I'll try not to keep it too long. PNC is doing great. They had a lot of really interesting conversation, and I actually think they did one of the best decks for the regional banks. And really, what they were saying was that the margin cost of funds is so. One of the things that hasn't happened at all, but could actually benefit all the banks further, is that because there is credit tightening, you usually see that like the actual dollars that are being applied to debt right this minute in time is kind of going on a pause just to wait and see what happens. But as a result, usually what happens is the spread will widen along with it, and it has not, which is kind of a unique thing. And that's what the CEO of PNC said that they saw. Additionally, he also indicated, and I indicate this, I've discussed this as well, so I'm glad to hear someone feels the same way I do, that this idea of penalizing people for having long duration assets on their balance sheet, like a 30-year fixed mortgage, is a little strange given that, you don't have the default risk associated with some of that. Those people are just paying it's just penalizing for something that doesn't necessarily match the credit risk associated with it, but does match the deposits extremely well. So it's a little bit strange to continue to isolate in that manner, and what that impact will be long-term of the banking system is a little strange. And the reason I mentioned that is because Jamie Dimon said something that I thought was a little bit intense, and that was he felt that banks shouldn't be holding loans at all. And that statement is from a very intelligent person. The processing of what that would mean a bank actually is like fundamentally transformative if that's the strategy that JP Morgan's going to do. But that is what it is. I do want to show you PNC because they're not trying to separate out loans in a particular way. They were a lot more conservative in suggesting that held to maturity is at 70% of their assets. And let's see other things. Yeah, about 50% of their deposits are uninsured. So from time to time, people get upset with them, but I don't think their assets are going anywhere at this particular juncture. Citibank. Yeah, again, if you look at the way that they do their loans, I'm going to skip through some of these. Yeah. So Citibank, the only things I would mention that were really interesting about what Ms. Fraser had to say really had to do with her commentary on where they sit within the financial system. So they believe that they've benefited a lot from international folks that need a bank with multiple currencies. Citi really is the one that you would go to. I know a lot of people in the US may see JP Morgan Chase as the largest bank, but when we talk about international breadth and footprint, it really would be Citi at that point. And they've benefited from being able to provide those services. I think that's part of the reason why their tangible book value did what it did this quarter. Now, whether or not that means they're out of the woods or not, it's a really tough call. But fair and square, this is the most progress I've seen them make throughout all of this, despite that they did get a lot of pushback on that. Now, am I ready to be really bullish any of these? JP Morgan, maybe, but that book value, price to book value isn't super exciting to me. If I'm looking for the most bang for my buck, if I'm looking for pure safety, JP Morgan's fine. If you own it, definitely don't sell it if your vision is longer in term. And then the last thing that I will just mention before we move on to questions is I just want to show you what's still left on the calendar. Everything in gray is already reported. Everything that is not in gray is still to report. And you can see that we've got a lot of banks that are still reporting. I will say that more of the regional banks are going to tell us a little bit more about where regionally there might be some issues, and then each one of them kind of has their own strategy. PNC, like I showed you, does have a lot of large customers, but given the nature of what they hold, they're quite a bit different than, say, First Republic, which, Corey, I can already see your question there, so I'm going to answer that in just a second. And so on and so forth. Comerica, ticker CMA, I will be watching for because they have probably more real estate exposure than others, and I kind of want to see what that looks like in the middle of the country versus primarily coastal or in the big banks who do a very particular type of mortgage lending. And then consumer finance will give us a much better picture on the consumer lending space in general. Again, have a look at my previous stuff, in particular, my video on SoFi. I discussed this ad nauseum. The consumer lending loan margin is much higher than the other types of loans, but it is non-securitized. So we'll be looking for credit deterioration here. American Express, typically going to be a higher quality customer. As you get farther down to Discover, Synovus, Synchrony, and Capital One, you have different tiers of what their credit rating would be. So if we're looking for the more fragile parts of the system, we'll probably see it in consumer finance, even more so than regional banks. Okay, everybody's been so excited about regional banks; they really should be looking at consumer finance, in my opinion. And then we'll be looking at the brokers. The one that I'm the most worried about still is Schwab, because they came in to the quarter with 7% CET capital reserve, given their acquisition of TD Bank. That still has been a special sauce ever since they've acquired it. And then I'll be looking to see how funds are flowing through the asset managers. And I'll also be watching the custodian banks for the first time. I'm actually really worried about them. That's going to be Bank of New York, which reports first and foremost, because the custodians, they had baby tiny bits of crypto stuff that they were trying to do. Now, crypto's benefited quite a bit in the last quarter, so we'll see what they have to say. And also, I'll be interested to see if there's anything weird going on with the custodian banks as relates to them managing all this extra stuff that's happening with the short market. Believe it or not, they actually do have some, because they are the custodian on a lot of that stuff, there's a lot of extra that they might have to do as relates to regulators. Plus, they are still a bank, so they kind of sit in this weird spot. So that's going to be, for the custodian banks, we're really looking at Northern Trust, which had a rough time last quarter, Bank of New York. It's really those two on the list. Okay, cool. Now, let me take it off share real quick, and then let's get to Corey's question. I know everybody cares about First Republic. Are they still at risk? The answer to that question is a resounding, I don't have a great answer, but I can absolutely tell you for what I'm looking for in the quarter, okay? First Republic, if we weren't worried about what happened with Silicon Valley Bank, First Republic was a wonderful bank. Okay, I don't have another way to say it. They've got a solid management team, et cetera, et cetera, et cetera. But nonetheless, they don't have the client diversification of a much larger bank. They're mostly a very particular type. So from the perspective of if a handful of people walk out the door, you could still get something that looks a whole lot like Silicon Valley Bank. Now, I don't think that I am really thinking that at this point that might be over, given what I saw in this initial bank earnings, these like 5 data points that I have, which are not the majority in any way, but do represent. So I feel like that part is probably okay. Then it's really going to be whatever they come clean on as relates to duration and what the problems are there. Because here's the thing, even though I do think that this whole duration mismatch is a little bit overdone, given if they are just allowed to hold it to maturity and they don't have any kind of risk of the deposits leaving, they'd be just fine. The fact is, there's a lot of people that are watching for that. And if they watch for it and then decide to pick up and leave, then that is what it is. But if we looked at any other period, that bank looked like a champ, for lack of a better way to describe it. So if anything, I'm more rooting for them than against them. But like I said, and I have been saying for all of the things I've been doing for the last 2 weeks, strangles are your best friend. They are your best friend. Dave, thank you so much. And I don't know, I'm not seeing any comments come through, so I don't know if you guys are printing comments or have questions, but it is Saturday and everybody should enjoy it as we move into earnings season proper. Thank you guys so much for watching. I super appreciate that. I know you guys have other things that you could be doing with your weekends. And if you have questions, put it in the comments below. I will officially be going into earnings season, so I'll do the best I can to respond to stuff. And take care. Happy Saturday.